Thank you so much. Well, it's great to be here. Thanks everyone for coming out. It's an honor to be with this crowd of professors, and I want to thank the ESG initiative in particular for supporting this research. So I am a real estate and finance professor. I think that studying the housing market in the United States is the most important market for understanding households and understanding the macroeconomy. For most households, the house is their largest asset, the mortgage is their largest liability. The housing market you can think of as being about $32 trillion in home equity and about $14 trillion in mortgage debt. What happens in the housing market deeply and substantively affects where the macroeconomy goes, to the point where macroeconomists have written papers that say the housing market is the business cycle. And in thinking about how this ties into climate, I came to this a few years ago now thinking about these investments that households have made. They've made very large investments. Their most important investment in something that is durable, illiquid, immovable, right? Deeply exposed to the risks of a place, of a specific location. And when you talk to buyers or you talk to mortgage lenders, they say, well, that's the insurance industry's problem. The insurance industry is going to deal with the issues of climate change, and we don't need to think about it. And so we said, okay, well, that's interesting. Let's dig into the insurance market, try to understand what's going on there. And what my co-author Phil and I ran into is that there's no data on the insurance industry. It's very difficult to figure out what are homeowners actually paying in homeowners insurance. And so we set out to solve that problem with this project. And what we did is we created a new data set of how much homeowners are paying in their homeowners insurance, and we backed it out from their mortgage payments. So most of you are not homeowners, but those of you who are will know this, or your parents will know this, which is when you make a mortgage payment, you're not just paying the principal and interest on the mortgage, you're also paying your taxes and you're paying your insurance. And that is paid through an escrow account, a third party that makes sure that those bills get paid on time. Your mortgage lender really wants to make sure that you're current on your insurance so that they're protected and that you're current on your property taxes. We were able to back this out of an enormous data set of 12.4 million mortgages, over 47 million premiums backed out from these escrow payments from 2014 to 2023. And this project gives us unprecedented detail and unprecedented insight with granular geography at the zip code level about how much homeowners are paying in their insurance. So this is one of the big payoffs to the research, which is a map like this, which as far as we know has never been made before this project. And we were really lucky that the New York Times was interested in this as well. So they made a version of this map over the summer, which is way prettier than my map. So you can go on the New York Times website, and their data visualization people are really good at this. There's a few things that jump out looking at 2023 homeowners insurance premiums. Obviously, Florida and the Gulf Coast is extremely expensive for insurance, very exposed to climate risk like the back-to-back hurricanes that we've just seen. But you see some other places like eastern Colorado, and then Tornado Alley, Oklahoma and North Texas, where when you talk to folks there, they say hail and tornadoes have gotten so severe and so unpredictable that a lot of insurance providers are actually leaving the state. They're not offering policies anymore, and that's driving up the cost of premiums. With this enormous data set in hand, we're now developing a number of research projects. The first one that we're thinking about is, this is my other map that I was going to show you. I'll show you this one first. This is Miami. So now we can drill down to the zip code level, and you can see, within Miami-Dade County, South Beach is in red here, over $8,000 per year if you want to have homeowners insurance on South Beach. You're probably happy to pay that if you live on South Beach. That's a rounding error to you. But for a lot of households in these other parts of Miami, this is an enormous burden. If you look at this over time, what you see is a dramatic spike in insurance premiums starting around late 2020, early 2021. A number of explanations for this related to inflation. Change from a zero interest rate world to a non-zero interest rate world drove up insurers' cost of capital. Inflation drove up the cost of repairs, the cost of materials, the cost of labor. There's also some capacity issues in the reinsurance market that have made pricing very difficult for the primary market. What we show in the paper is that this growth has been disproportionate in the most climate exposed parts of the country. And so this is the last thing I'll leave you with, is if you think about the relationship between disaster risk and the price that you pay for insurance, what we show is that that was basically constant from 2014 through 2020. There was basically no change, a 1 standard deviation increase in the riskiness of your location based on the National Risk Index corresponded with about a $300 increase in your premium. Now that's over $500. And so, what is a standard deviation of the risk index? Well, think of New Orleans. New Orleans is 4 standard deviations above the average in the US. That means that New Orleans residents pay about $2,000 more for homeowners insurance. And so if you're thinking about what's going to spur adaptation in this market, $14 trillion of mortgages, $32 trillion of home equity, it's this, right? It's the rising cost of disaster risk. This is what's going to spur adaptation. It's going to spur investment in resilience efforts, and it's ultimately going to spur retreat from the riskiest areas. I'm out of time, so I'll stop there. One very brief note outside of this, I'm teaching a brand new class this spring that's called Data Analytics in Real Estate. And so if you're interested, it's a half semester course, and I hope to see many of you there. Thanks so much.